Good morning. Good morning, everyone. Great to see a bunch of you guys on right now. A little bit later today, but, as they say, better late than never. Friday, as some say it. Morning, Alison. Morning, Brendan. Stephen, Sean, and James, and Hardick. Good to see you guys. Thanks for joining. Wonderful to hang out again, as always. Anyone who's new, my name down there, Jason Whitten. Been property investing over 20 years, coaching property investors just like you, over 18 along the way. Learned a few things each morning. Get to share them with you with a bit of a wealth coffee chat. So, welcome along. Welcome along. If you're new, let us know. Give us a shout out in the chat. Say hello. Hey, good morning, James, and good morning, Margaret. Good to see you guys there. Hey, today I thought I'd talk about something. It's an interesting one. Well, I think it's interesting. But we shall see. Let me see if I can do this in a good way. Let me see if I can. There's camera 3, camera 4, camera 5. Ah, there you go. Camera 5. You can't see my face right now, but you can see one of my properties. Investment property, settled it in February 2020, which is kind of cool. Bought it off the plan. Some of you guys know. This property. We had a couple of them for our investors, and some of you guys might have even bought this property in Canberra. So purchased this property, and I want to talk about, capital growth is not linear. And at the moment, what's going on out in the world of what do you call it? Data land, right? There's a bit of a movement around making the data in real estate kind of in real time, like the stock market, which is completely flawed, right? It's stupid. Real estate does not move, does not transact, does not have the speed of market that share markets do. And any attempt to do that is, in my mind, completely flawed, because there's human interaction in it, where the share market is quite detached from its value. It's nice. Like you don't go, oh, I love the look of an Apple share. I love it. It just looks so great. I've got a great view. There's shares and property from a data traveling point of view are very different. Anyway, there's a bit of a movement out there to go, oh, check your values monthly. Your Hardick's talking about, valuations from CoreLogic, and there's other providers in the marketplace, but they're so volatile and inaccurate. I want to talk about, what provides growth today, or, how growth comes, because you guys know we've talked about this before. Capital growth is not a linear process, okay? It's not a linear process. So let me go back to this is one of my properties, bought in February, like, hey, it's up, technically if I look, from February to March, 630 to 687, woohoo, I've made money, right? And that was bullshit anyway. But, this is a little bit of data. And then I've in April, 666, I've lost money, right? This is so stupid. And then now in May, 632, I've lost more money, and then, I'm back up, 652. And then, hey, 667, yay, I've made money. Oh no, I've lost money. I've made money. I've lost money. I'm now losing more money. And, that is stupid. Like month to month, analyzing a property like that, right? How dumb. It makes no sense. And growth doesn't occur like that, folks. Like, that is not capital growth. Like it's ludicrous. Like to think that is the fact displayed in data like that, that volatile in the real estate game is not right. Okay, that's not real. That's not how it looks. You can get a daily roller coaster, well, a minute-to-minute roller coaster, can't you, on the share market, Alison, right? So, we get a month-to-month roller coaster in real estate. So, for all of us, we want to understand, real estate growth. How does it work? Like the real growth, the stuff you can use. How does it work? And I've said this plenty of times, gang, everyone listening in, capital growth is a vanity metric. It's a vain concept. If you buy property and the only way you succeed is it grows in value, that's vanity, folks, right? You don't control growth. And some days you're winning and some days you're not. If you own real estate, if you build a portfolio, irrelevant of its value at any point in time, you are winning, right? You are making progress towards a goal. The longer you own it, the more certain the more certainty you can have that wealth and income in the future will be created. Right. So let's stick to the plan today. So how does these 15-year cycles occur? Because at the end of the day, November 20, I've made money. And then, it's flat, and I've had no growth, blah, 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 blah. Oh, it's up, let's go. Yay, whatever. And if we fast forward to today, $888,000. So, happy days. I'm a happy guy. But if I would have been tracking my property portfolio, and let's say it went flat for a while, according to that data, maybe 1, 2, 3 years, team, I see people giving up. I see people chucking their toys. I see people having a little cry in the corner. Oh, my property went down. I lost money. It's a bunch of shit. The only time you ever lose money in real estate when it comes to your values is when you sell. I wanted to sort of touch base on that today. How do you know that the capital growth is real? And what triggers like true capital growth? And Sam and I were talking the other day, he mentioned something at mentoring the other night, and he calls it mean reversion. Mean reversion. Now, it's a very technical term. It's out there. You can search it. But basically, what happens, mean reversion, or the idea that your property is banking, right? When the rents increase, your property or your assets often are banking value that is unrealized, right? So there is realized growth, right? Let's talk about what that might be. We'll put it up here. There's realized growth, which is the stuff you see immediately, and there's the banked growth, okay? So realized growth is pretty easy. Right now, I bought something and it went up in value, okay? Now that's happens in a momentum market. Now, often in a value market, which means you're buying something fantastic for the money when it comes to value, and we mentioned this yesterday, Alison brought it up, I think yesterday or the day before, you're buying a quality location, like a crazy quality location, with a crazy quality property, with crazy quality like infrastructure and amenities and stuff around it, which would then attract an exceptional quality tenant, right? So in a value market, these things, the quality of the location, the quality of the property, the quality of the infrastructure, the quality of the tenant, it gets banked, team. It gets banked, okay? But it's unrealized, I think that's how you spell it, unrealized growth, okay? It's unrealized growth. So it's building up. It's banking up. Think of this. It's like a volcano, like a bottle of champagne if you shake it, or a bottle of Coke, you shake it, it's got some pressure, okay? And what are the things that help us as property investors realize this banked unrealized growth? When we invest in quality things and have great pieces of real estate, great assets, but they haven't seen growth in either the value or the rents, more importantly, what builds up? What are the things that are going to help that unrealized growth pop? And in Sam's words from the other night, the average growth that we missed comes in a fast way in 1 or 2 years or whatever it might be. All right, so we're going to talk about that today. So, hey, morning, Ben. Good to see you, mate. So let's have number one, and chuck it in the chat for me if you think you know. What are the things that build up, that get saved up, that gets banked for the growth pop, the mean reversion later on? Okay. Hey, morning, Nekar. Good to see you. So number one, you're looking at it right now. What do you think this is? Tell me what this chart is. Tax depreciation. Yes, Hardik, like the value of a new property versus an old property gets saved and banked for later. Time, certainly, Alison. So as time goes by, what are the things that are occurring in the marketplace that are kind of being that are being literally banked and saved up, that are going to make the values pop? So this one right here, this is a chart of inflation, right? Inflation. So if you think about this, every year that goes by, a certain things get more expensive. And you'll probably see, if you haven't already, if you're building, I told you guys yesterday, the day before, I'm building a house, and the cost of me building my house, an investment property, has gone up. It's $71,000 increase because of the shortage and the inflationary issues to do with constructing real estate right now. So, but inflation, 2%, 1%, 2%, 3%. As time goes by, if your property hasn't grown, it's banking this inflationary pressure, okay? So it's banking an inflationary pressure. Now, that doesn't mean it's going to get that banked value, because if you buy a rubbish property in a rubbish area with rubbish infrastructure and you have a rubbish tenant, you're not banking anything. You're banking a decline. You've locked in a decline in your wealth, okay? So let's say inflation, we've banked some growth. Let's say 5 years go by and we just do 5 times 3. That is a potential 15% pop of value banked because of inflation. Everyone following along? Okay, so, and what else will pop the values when the timing is right? Well, things like mortgages, right? So if you have a look at here, call it, 2016, the cost of a mortgage is literally 50% less, okay? 50% less in real cash terms. So when it's less expensive to buy a piece of real estate, all right, we get a pop. We get a pop in value. Okay, so technically, other than when APRA and those guys got involved, technically, if this was very linear, you could say anyone could afford to buy a property for 50% more than in 2016 with the same income in 2022. Now, that's not exactly right, but it's certainly about 20% more right now with the same income from 2016. Okay, so boom, we've got inflation saved up for over 5 years. We've got low interest rates. Now, that doesn't mean everybody is going to run out because money's cheap. It's not. That's not the only thing. What else happens? All right. Well, there's another thing that gets saved up and pops for people too. The rents start to go up. Okay. If you have a look at this, on average in some of these cities, 10%, 14%, 16%, 13% for houses, 11%, 9% in apartments, 21% in apartments in Darwin, crazy times. So what else is happening is the cost of renting is going up, right? So the cost of renting's going up. The cost of money's getting cheaper. We've saved some inflation up, okay, because that's the true sort of underlying cost pressure building up. So there's these things. It's the reason this thing's going to pop and blow its stack, or give us the mean reversion, the saved up, the banked equity, the banked growth that we desire. And one little thing to point out here, folks, this is why for me, we chatted about it the other day. This is why I think Melbourne is the value market right now. I believe Melbourne's the absolute value market out there in the marketplace, because everywhere else has had actually a much better time of it, folks. Much better time of it than Melbourne. And Melbourne is still, 5 or 6 million people. I think 5 or 6 million people. And the lowest rents in certain property styles in the country, folks. Anyway, you wait till there's 100 or 200,000 people come next year or the year after for immigration, right? It's going to happen, ladies and gents. So we've saved it up. We've got pressure. We've got pressure in interest rates. We've got pressure in rents going up. Let's have a look at what's going on. And I showed this one the other day. The proportion of somebody's income to pay the rent is at literally all-time highs, okay? All-time highs for rent versus buy, okay? So we've got another little popper going there. Consumer confidence. Now, this is it's gone back up again like this. Couldn't find the full chart. But again, people are confident. They're feeling good. Like, lockdowns are finished and, other than Omicron and all that sort of other rubbish, whatever's going on, people are feeling a little bit more confident. They're out there in the marketplace looking around. And then the other thing, which is, putting pressure in a negative way, is like, there's been no construction, folks. And then, the supply chain is absolutely poleaxed, right? So when we're looking at this market here and we're saying, all right, where is this unrealized growth? Unrealized growth when you bank it, but you didn't see it, so you can't use it yet. We need to think about what that means, okay? And there's multiple other ones as well. There's infrastructure projects, right? Melbourne and Brisbane, like insane infrastructure projects being poured in. Brisbane's pretty, everyone's like, oh, the Olympics, yeah, that's sweet. There's billions of dollars there, Don't overlook, Melbourne having the largest public infrastructure upgrade for their train and tram line in the state's history, the largest, right? So we're thinking, all right, what's going to pop? What's going to push it? And it's based on the quality conversation of real estate, location, infrastructure, and tenant. But you've banked the growth. You didn't get growth. You didn't get growth. It's either realized or unrealized. Okay, that's the way we need to look at property, and understanding that growth, capital growth in real estate, is not a linear process, never has been, never will be. Growth in anything is never linear, ladies and gents. You, me, the stock market, the property market, as we go. So hopefully that made sense. It was a little bit sort of bitsy today in a few of those charts, but I just wanted to show you, like, if your properties haven't grown yet, if you're back here, folks, if you're back here, if you're back here, oh, you can't really see that now, but I'll go back here. If you're back here at 622, and it looks like, oh, I even lost money. I went from 684 to 622. I've lost money. Boo-hoo-hoo. Like seriously, get over yourself. This is not how the world works. This is not real estate. Real estate is what have we banked, and it's going to realize itself over the next 10 to 15 years, maybe sooner, maybe later. If you've purchased a good property, then it's going to be on. And then you let it do its thing. And then, one day you wake up and you've got some equity in the bank that you can use and realize. Anyway, hopefully that made sense. Oh, I'm going to sneeze. Hang on. Well, that was beauty. Live television and stuff like that. Anyway, Alison, Yes, Wealth, Wine and Wisdom is on tonight. Join myself and Andy for almost the final Wealth, Wine and Wisdom of the year. Thanks, Graham. And yeah, that's it. Wealth Coffee Chat done. Hopefully that made sense. If it didn't, let me know. But yeah, remember, we bank future value. How do we get to realize it? The quality of the real estate in the right location with the great infrastructure attracts the right tenant, waiting for compounding growth. That's it. Heartache. But sometimes you do have to have a good look at yourself and your portfolio. And if you've got properties in places where the banked potential is never going to be realized because there's not enough pressure, in those locations to realize the banked growth, then you have to cut and run in average properties. And Sean's right, like you never sell. But there's one bit before the never sell, Sean, it's the buy well. And if you don't get the buy well right, you have to flick the piece of rubbish real estate you got. Then you buy well, and then you'll never sell. All right? Thanks, team. You guys are awesome. Join me tonight with Andy Fenton, financial planner extraordinaire, when we chew the fat about what's going on, as we always do on a Friday evening. All right, you guys, be awesome. Take care. Have an awesome day. And, yeah, bye for now. Join me tonight. You guys know. Bring it on. Thanks.